First of all, I would very much like to welcome Dr. Rey, the Lord Bagri Professor of Economics at the London Business School, and I wish to express my sincere thanks to her for participating in the 38th edition of the Barcelona Graduate School Lecture Series. I would also like to extend a warm welcome to Professor Jaume Ventura and to all of you, students and members of the Barcelona Graduate School of Economics, ladies and gentlemen, to this evening at Banc Sabadell. In a moment, I will hand you over to Jaume, who will highlight Dr. Rey's distinguished career. But before this, though, I would like to say a few words about the topic of today's lecture, since it's especially relevant in the current global context. A salient feature of the Federal Reserve's recent tightening cycle has been its lack of impact on global financial conditions, which have remained very supportive. Evidence from the BIS and also the ESM suggests that this could arise from an increased use of the euro as an ultimate funding currency. On the political front, Brexit, the America First policy, and the emergence of China as a key player are all elements which are reshaping the post-World War II global system. What seems clear is that the relative importance of the US dollar and the euro in the international financial system is likely to remain a central question for researchers and policymakers alike. So since this topic is of the utmost importance, today is a privileged opportunity for us to gain further insights into the current complexities of the global financial system. So thank you very much again, Dr. Rey, for being here. And Jaume, the floor is yours.
Thank you, Sophia. It's a great pleasure to welcome here all of you today for the 38th Barcelona Graduate School lecture. And it is especially great pleasure that today the person that will deliver it is Hélène Rey, excellent scholar. Let me tell you a few things about Hélène. I cannot tell you all of them because she needs some time to make the presentation. But a short summary is that Hélène Rey is the Lord Bagri Professor of Economics at London Business School. Previously, Hélène was at Princeton University, where she was a professor of economics and international affairs, both in the economics department and the Woodrow Wilson School. She received her PhDs, she has 2 PhDs, from the London School of Economics and from the École des Hautes Études Sciences Sociales. Hélène's research has focused on a variety of topics, and many of them. Particularly, I would like to emphasize the determinants and consequences of external trade and financial imbalances, on the theory of financial crisis, and also on what we're going to be talking today, which is on the organization of the international monetary system. One of the characteristics of Hélène's work is a combination of empirical work, high quality theoretical work, and most important is a focus on current issues, on on topics that are of interest not only for academics but also for the community at large. In fact, she has had a significant influence both in academia, not only in academia, but also in policy circles and so on. Besides her many publications, Hélène has received numerous awards, and I'm going to just tell you a few. She has obtained ERC advanced grants. She obtained the Bernasser Prize for the best European economist working in macro and finance under the age of 40. She also obtained the inaugural Birgit Grodal Award from the European Economic Association, who honored the European-based female economist who has made significant contributions to the economics profession. She won the, I cannot pronounce this, YRGO Award, Johan Jansson's Award, for the best European economist under 45 years old, or the 45, who has made a contribution to theoretical and applied research to economics in Europe. She has won the inaugural Karl Menger Prize, Edouard Bonfus, Marozale, and a bunch of other prizes that you can find in her CV. There are plenty of them. She's a member of the an elected fellow of the British Academy, of the Econometric Society, of the European Economic Association, of the American Academy of Arts and Sciences. She has also been awarded the Order of the British Empire for her services to economics. She has also participated in editorial boards in a bunch of interesting journals and top journals. But I would like to say that Hélène is also, as I said, despite, in addition of her many contributions to academia, she is very active in policy. She's a member of what I will not try to say, but it's the French Macroprudential Authority. She has been on a commission, the LAC group on the international economy, and she often participates. For example, she's been participating in the Jackson Hole meetings in where she has presented her opinions. She has given the IMF Annual Research Conference, the BIS Andrew Crockett Memorial Lecture, just to tell you a little bit how connected her work is with academia. I don't want to extend me more, except to say that it is a very great pleasure and an honor to have Hélène here, and that she has agreed to give her presentation on the international monetary system. And it will take about 1 hour, more or less, and at the end we will have a round of questions from you. So I would like you to welcome Hélène here. Thank you.
Thank you very much. Well, it was far too nice and far too generous from both the two speakers. So thank you very much for your hospitality. Thank you for the invitation. And as they were speaking, I was thinking, wow, I'm getting old, definitely. And now you can also hear me. I hope. Can you in the back? Yes? Okay. Very good. So tonight, I thought I'm not going to present one paper. I'm going to present a series of ideas or views that come out of actually a bunch of my papers on the role of the United States in the international monetary system in particular, with some view on global financial cycles. And I'm going to be drawing on some work I've been doing with mainly co-authors, in particular with my longtime co-author Pierre-Olivier Gourincha, who is professor in Berkeley. And also tonight some paper with Silvia Miranda Agrippino, who was a postdoc at London Business School and who is now at the Bank of England. So based on all that, I'm going to go over a few ideas. Could it be my phone? I see there are already some protests as soon as I start talking. It was my daughter. Sorry. So I'm going to present a series of ideas about the role of the United States, and you will see I will look at the international monetary system and the role of the United States from different angles. So the United States, as it was mentioned in the presentation, is extraordinarily important in the international monetary system from very many different perspectives. And we see that because if you look at international financial markets, you will notice that obviously the dollar is very often used for international trade transaction, but it's not the only thing. There are lots of financial assets which are denominated in dollars. Dollar assets are very liquid. There are lots of countries who are pegging their exchange rate to the dollar. There are a lot of reserves which are held in dollar. The dollar as an invoicing currency is important, and the dollar as a banking currency used in funding in the banking system, in particular for global bank, is also a key currency. So this has a number of very important implications, and at the same time, it makes the issue very multifaceted. So one can take a look at it from very different points of view. So tonight, I'm going to refer first relatively briefly about the importance of the dollar as an international currency and as the role of the US in the international monetary system from the point of view of the sustainability of external deficits and the role of the United States during global crisis. So these two things, I will be relatively brief. This is the work I've been doing on the story of exorbitant privilege of the United States and exorbitant duty and of the United States in crisis, and I will explain what I mean by that. Then I will discuss also briefly my work on the independence of monetary policy, the transmission, in fact, of US monetary policy to the rest of the world. And this is about the global financial cycle, and this is about the Mendelian trilemma. Okay, so that's going to be a second aspect. And at the end, I will spend a bit of time on some recent work I've been doing with Pierre-Olivier on what we know now about global real rates, and in particular, some kind of view of what has been going on with global real rates. And you will see that we think it is related to these global financial cycles type of issues. So that's the menu. So it's a different course here. But let's see how we go. So the first thing I'm going to show you is to set the stage again. So that's going to be the exorbitant privilege of the United States, and the exorbitant duty of the United States in the international monetary system, the way Pierre-Olivier and I started to think about it long ago, and now we have been doing some more work about that. So what is it? So we started to think about the US as an important financial intermediation actor in the world economy. And in particular, we started to document the external balance sheet of the US as a country. Okay, so a country is investing abroad and has investors also buying some of its assets. So it has an external balance sheet. It has external assets and external liabilities. And what I'm showing you on this picture here are the external liabilities of the United States at market value since the post-war, so since 1952 and up to the end of 2016. And what you can see, and so these are gross external assets, these are stocks of assets, which are decomposed so in different colors because there are different types of assets. So the bottom, for example, the bottom tranches are the banks, the banking assets. When I say assets, I mean it's a bit hard to say because these are the liability side of the balance sheet. But so they are the banks, they are the bank loans that are being held by foreign investors, US bank loans held by foreign investors. That's then the green, for example, bit is going to be the direct investment. So if you have a Japanese investor buying some firms in the US, that's what it is. You have also, very importantly, these kind of light blue and orange tranches here, which are debt. So the light blue one is government debt. And you can see that in the recent period in particular, government debt is a big chunk of the external liability of the United States. Corporate debt is also not negligible. So what comes out very strongly, I think, of this picture is that, first of all, we have financial globalization since essentially the 1980s, but really speeding up in the 1990s. And then that you have the stock of external liabilities that has grown quite quickly and that has different components, out of which the debt component, the liability component, the debt liability component is a sizable component. So that's the external liability structure of the US. If we look at the external asset structure, so same period, you see that also you see the kind of cross-border financial globalization, but you see it's very asymmetric. You see it looks very different in terms of color and shape. So why is it different? Because on the asset side, you have a lot more foreign direct investment. That's the green stuff. And also above it, that's the equity portfolio component. You see that this is quite big compared to what we had on the liability side. And conversely, the red bit, which is debt, is super small. Okay? So on the other hand, banks are kind of important both on the liability and the asset side. But what is pretty clear is that on the asset side, there's a lot more risky asset in the sense of FDI and portfolio equity than there was on the liability side. And the liability had a lot more debt, in particular US treasuries, government debt. Okay? So that's an asymmetry. And this is an asymmetry that is saying more or less you are short safe asset, you are long risky. So you perform some kind of intermediation function, a bit like a banker, or I would argue maybe more a bit like, in the end, an insurer, but I will explain why I go from banker to insurer. Certainly, because of this asymmetry, you would expect that you are going to have a particular pattern of return for your external balance sheets. And what you would expect, since you are long risky and short safe, is that you are going to have some excess return. And this is the case. So if you compute on this long period of time the excess return of the United States on its net external position, you will find that the excess return is about around, let's say, 2% real per year on the whole period. So that's not negligible. Okay, and that helps on the external adjustment side. So this is what we call the exorbitant privilege of the United States because of its particular balance sheet structure. In particular, the United States is able to sell a lot of debt to the rest of the world, which actually wants it, possibly. So we have an external, an excess return on the external position. That's the exorbitant privilege. However, and this is pretty apparent when you think about it as well. So if we keep on thinking about the implication of this asymmetric balance sheet, so here I have put it in a different way, it's a different view, it's the net position by assets. So net position for debt, for equity, FDI, etc. So what you see is that the net of equity, the net of FDI are the stuff above the line, above zero. So we are positive. We are long on that in equity and we are long in FDI. However, the stuff below zero, this is the net debt in particular. And you see that it's super large. Huh? It's super large. So we have this extremely leveraged position in some sense. That's what it means. And what it also means is that, so besides the trend of the US net external positions, so gross assets minus gross liabilities going down over time, which you clearly see here, you see that there are very sharp, sometimes drops in this net external position of the US. And one of the very sharp drop is here. That's the global financial crisis, but you see pretty sharp drop as well here in the recent period around the euro area crisis. So if you have this leverage position, what it means for you is that when you have big shocks, like global shocks in particular, everything that is risky loses a lot of value during a crisis. All your equity positions, everything that has a lot of risk in it loses in value. On the other hand, you have issued, on the liability side, a lot of debt, treasuries, in particular government debt. That's what we saw. This is the safe asset. So during crisis time, this thing does not go down in value. In fact, it goes up. So if you think about what it means in terms of wealth transfers from the US to the rest of the world, what it means is that the asset collapses, the liability goes up. So that's a negative wealth transfer from the US. So that means the US is transferring wealth to the rest of the world. That's a very negative hit on US net foreign asset position. And this is what you see when you have this kind of cliff edge things here in the movements of a net foreign asset position. So this is what we call the duty. So what we say is, in the end, the exorbitant privilege, it's just the same thing as taking the fee. As an insurer, you get some kind of premium because you are selling insurance to the world in normal times. But then in crisis time, you have to make this, well, the structure of your balance sheet implement these transfers for you. You are insuring the rest of the world. That's the duty. So that's what we formalized in a new paper with Pierre-Olivier. And we can then, because we have a formal model of insurance, we implement this idea by modeling the US as being effectively less risk-averse than the rest of the world, maybe because it has better financial markets or better fiscal capacity. So this shows up as an asymmetry in risk aversion. And within that framework, we can reproduce exorbitant privilege, exorbitant duty, shape of portfolios, adjustments, and also we can think about what happens when the relative size of the US in the world economy, for example, goes down, which might be a relevant experiment for the future. So that's one thing that, one theme that I wanted to discuss tonight, which is the idea of the US being a global insurer and implementing the insurance via its external balance sheets. Now, however, another way the US is very important in the world economy is through what I would call global financial cycles and the effect of the US on these global financial cycles. So what is a global financial cycle? Well, I would define it as fluctuations in financial activity measured by some restaking measures, some credit creation, some asset prices, capital flows, leverage, fluctuations of all this stuff, this financial activity on a global scale. Okay, so that's how I define a global financial cycle. And there is some evidence that there is a lot of co-movements in all these variables that I mentioned around the world. So if you look at measures of capital flows, if you look at measures of asset valuations, credit creation, so obviously not everyone is co-moving one for one, and there are some asymmetries between the biggest financial areas and some very poor or emerging markets without much market access. Obviously not everyone is the same, but there is quite a bit of commonality in these measures. And what I showed in one of my papers with Silvia Miranda-Agripino is that the United States monetary policy, so the Fed monetary policy, is one of the driver of this global financial cycle. So let me expand a tiny bit on that. So why, first of all, why is it interesting to think about this global financial cycle? So it's interesting, I think, from at least 2 points of view. One is the point of view of financial stability. So if the US monetary policy is driving asset prices to some extent, leverage of financial intermediaries to some extent, not only in the US, of course, but cross-border. For example, globally systematically important banks in Europe. Then this is an important factor for financial stability. So it could be, think about it, that you are in a country which has already a pretty booming financial market or booming real estate market, that what would be optimal for you would be to try to cool that down. And then you have the US, who might be in a different phase of a cycle and with actually sending you some more stimulus, more financial stimulus through some kind of loosening of its monetary policy. So that can be an issue if indeed dollar funding and asset valuation, etc., can act as an amplification mechanism for whatever is going on in your domestic market. So the global financial cycle can, cause some issues in terms of financial stability around the world, and so I guess a corollary to that is the discussion I've had in Jackson Hole about dilemma versus trilemma in international monetary economics. So what is that? Well, so there is a very time-honored tradition in international economics that we have a trilemma in the Mendelian tradition, which says that it is impossible to have at the same time an independent monetary policy, a fixed exchange rate regime, and capital mobility. You can have two of the three, but you cannot have the three at the same time. Okay? And this is more or less linked to, if you have capital mobility, you can immediately bring capital to a place in which the interest rate would be higher than in another place, and therefore, if you have a fixed exchange rate regime, you cannot have an independent monetary policy, and vice versa. So this is something that is very important, but out of this trilemma, people have often understood it as saying, well, there is a corollary, which is that in theory, it is therefore possible to have an independent monetary policy in a world of capital mobility, but if you have a flexible exchange rate. So we are in a world of capital mobility in many parts of the world, and people have been, in a way, betting on the fact that if you have flexible exchange rate, then that's enough to insulate your country from the global financial cycle, and you can have an independent monetary policy. So often, for example, IMF prescription in the face of problems with capital inflows for emerging markets would have been, well, you can insulate yourself, just let the exchange rate float, essentially, and that's how you're going to deal with that, and that's the corollary of a trilemma. So, but in practice, so if you believe what I said before, which is there is a global financial cycle, which may be important, which is driven by the US and which may not coincide with your own cycle, then that's not going to work. Even in a world with flexible exchange rate, you're going to get this external influence, which may be a threat for your monetary policy independence and your certainly the financial conditions in your own economy. So in the end, the argument that I'm making is, well, we don't really have a trilemma in the sense that even a flexible exchange rate doesn't buy you this independence. Really, if you have a powerful global financial cycle, you need an additional instrument besides your interest rates, your monetary policy tool. You need something else in order to deal with a global financial cycle. That could be macroprudential policy. That could be, in our case, that could be some kind of capital flow management or capital flow restriction. But you need this additional instrument, and this is important. So that's the whole motivation on the global financial cycle. Now I'm going to present you some evidence on the global financial cycle and of the fact that the US monetary policy is driving it. So here I'm just giving you some view on what cross-border flows look like in the recent period. So these are flows this time, not stocks. And in particular, the period which is obviously very important to understand now, because of what, of what happened, is the period between 2000 and 2008. And I almost fell because that's really, in 2008, this is really when everybody was falling down very dramatically. But you see that the flows during that period, that booming period, are very remarkable. So they really grew up quickly, and the most volatile bit of these flows were the cross-border bank flows. Okay? So there's a lot of volatility in these flows. Now, looking forward in time, and that might link also to the introduction that was made, it's not so clear that global banks or banking flows are going to be as important in cross-border flows, and maybe we are changing paradigm, and maybe it's going to be asset managers and other actors who are actually doing most of these flows. But certainly during that period, cross-border banks played an important role in international financial markets. So what I did in my work with Sylvia Miranda Agripino is to try to estimate the effect of US monetary policy, not only on the standard variables that we would always look at when we think about what does monetary policy do, which is GDP or industrial production, which is inflation measured in different ways, investment, etc., but also on financial variables. So in particular, credit creation, leverage, spreads, measures of risk, but not only US business cycles and financial variables, but also international financial variables, so the global financial cycles. So we ran a VAR with 25 variables, 25 because we wanted to be reassured that the type of results we get on the standard US business cycle variables look like what we should get when we have a monetary policy shock. But also added to these real sector variables, we wanted the financial variables, and in particular those measures in the international financial market. So we ended up with 25 variables. And we had to use, therefore, Bayesian techniques because of the dimensionality of the system. So we drew on some recent literature on that. And we identified the monetary policy shocks in 3 possible ways in the paper. So one is we reproduce the ways people have been doing things in the past by using some kind of Cholesky decomposition. But another way was by using an instrument, and so a proxy VAR, using the Romer and Romer narrative approach as instrument, for those of you you know, and also using some high-frequency instruments. And so the type of impulse response functions, or if you want, reactions of variables to the monetary policy shocks that we find are the following. So I didn't put the 25 on the same page because you wouldn't be able to see anything. So I'm going to put them in sequence. Most of them, not all of them, but most of them, and in particular the most relevant ones. So first of all, do we get the usual effect of a tightening of US monetary policy on business cycles variable? And the answer is yes. So here you have a 100 basis point tightening of a US Fed. What happened to real GDP? Well, it goes down. Consumption expenditure goes down. And you see that we don't have a price puzzles in the sense that we also have very well-behaved response of prices. So this is a personal consumption deflator, but we also have the GDP deflator, etc., if you want to look at it. There's also an effect on consumer sentiment. So to summarize on the business cycle stuff, we have also investment, we have plenty of more variables, we have real estate investment, it's all in the paper. We find textbook responses. So if you want to teach as an academic the effect of monetary policy, it works perfectly as expected. Now, what about the rest? So what about the credit? What about the financial variables? So here, this is the response of US domestic credit. And by the way, all these lines here, this is because systematically on each graph, I put 2 ways of identifying the shocks, okay, and then the standard errors across the impulse response. But you see that more or less it lines up. And it's true, you'll see that in the paper it lines up across methodologies. There's only one variable which is always a bit tricky, and it's the exchange rate, where we do find it's not super robust what we find. But for the rest, it tends to be robust. So for the US domestic credit, goes down. Tightening, US domestic credit down. So that's not super surprising. What is more surprising is that it's not only the US, but if you look at global domestic credit, excluding the US, it also goes down. So there is an effect beyond US borders of US monetary policy on global credit. Now here I added, besides global domestic credit, cross-border credit to banks, cross-border credit to non-banks. And you see that the cross-border credit goes down, especially to banks. So there is a strong effect, and these effects are significant and quantitatively big for this decline in global domestic credit and cross-border credit to banks in particular. So if you tighten US monetary policy, you do decrease those things significantly. Now this is the effect of the big capital markets banks leverage. So the first panel is the US broker-dealer, and you see a sharp, very quick decrease in leverage of the US broker-dealer. The interesting thing is that it's not only the US broker-dealer, but it's also the euro area banks, the big ones. These are the globally systematically important banks in the euro area. They have a very similar response as the US broker-dealers. And I also put the UK, GECB, which also have a response. It's less well estimated because there are fewer of them, but they also have a sharp decrease of leverage on impact. So you see that the US monetary policy does cross-border in international financial variables. Now there's another thing that we document in that paper, which is that US monetary policy has an effect on a big global component of valuation of asset prices around the world. Okay, so what do I mean by that? All of you who have looked at asset prices, you generally see that, in particular, if you look at a cross-section of stock prices across different countries, different continents, you will have noticed there's a lot of co-movement there. And that's a pretty striking thing. So what we have done is that we have taken a big panel of risky asset prices, stock prices, and also we have put corporate bond prices, every securities traded that we could find. And we have let the data tell us how much of these things have a common global factor in their fluctuation. So is there a global common factor that can explain a lot of the movements of these big cross-section of risky assets or not? And is there one global factor, or maybe is there two global factors? We can test for that. And how much of a variance of the fluctuations of these things is explained by this one or two global factors? And then we, of course, allow also for kind of more regional factors or sectoral factors, etc. And so what we find when we look at this big panel of risky prices is that the data tell us, yes, there is a global factor. There's one global factor. So we can reject the null of 2 in favor of 1. And that single factor explains about a quarter of the variance of the data. So that's, we think this is quite a bit. And this is what the global common factor and risky asset prices look like. So on a long sample, this is the dashed line, but the long sample is less broad. And then on a broader, shorter sample, which is a continuous line. And as you see, so we can see, of course, the effect here. We have the shaded areas, which are the US recessions. But you see that, in particular, well, we have a very deep, again, I'm not going to fall down again, but the 2008 one, right, which is pretty spectacular. So that's what the global common factor in world asset prices look like. And if you decompose it in a volatility component and something which would be an aggregate effective risk aversion component, you would get panel 1 and panel 2. So panel 1 is just global realized volatility. So that's just a measure of volatility based on risky asset prices, daily price, and then we compute monthly volatility. So you see that we had the very low volatility period between 2003 and 2008, essentially. And then we had a spike. Okay, so that's what volatility looks like. But if you look at the implied aggregate effective risk aversion, which is essentially projecting a global factor on the volatility and taking the residual. So that's what how we define here the effective aggregate effective risk aversion. You see that what is quite remarkable is during that period, again, 2003 up to 2007, we have this downward trend in effective risk aversion, and then we have a spike again, and then we stabilize at a somewhat higher level. And this is during that period that we, as you've seen, that we had the very big importance of global banks in international financial markets. Now, we have now this global common factor. We look at the response of, in particular, this factor and risk aversion to a US monetary tightening. And so what we find is that a US monetary tightening of 100 basis points lead to a lower asset price, so global asset price factor, leads to a higher aggregate effective risk aversion. Could you hear me or not? You missed everything in the back? So it leads to a higher aggregate effective risk aversion. There's an effect on the term spread. There's an effect. This is another measure of risk, which is taken from Gilchrist and Zachary. So again, in terms of responses of global valuations to US monetary policy, we find something there. So the takeaway, I think, is that US monetary policy is not the only driver, of course, of the global financial cycle, but it is a driver of credit creation worldwide, of this global factor in asset prices, of various measures of risk premia, of leverage of global banks, not only US banks, but other banks as well, and those cross-border credit flows, especially bank cross-border flows. So then with Sylvia, we think about a model where there's heterogeneous investors that could try to think about that, but I don't have time to go into that. And I also don't have much time to discuss this data, so I'm just going to move on to the last thing I want to talk about, which is also linked to the global financial cycle, but takes a very different view. In fact, we were not going at it from a global financial cycle point of view, but ex post, it turns out that this is something that we think is very important also for what is been going on in real interest rates around the world. So let me talk a little bit about that. So to sum up so far, we have seen the insurance role, we have seen the global financial cycle role, and now I'm going to take a step back and say, okay, what is very important right now as a stylized fact in international financial market? Well, there's something which has been puzzling quite a lot of people, and this is that the real rates have been low, have been going down for a long period of time, have been low. And there are lots of people who have been trying to explain what is it that is happening, what is behind these low real rates. I put here the US real rates, but I could have put essentially all the real rates of the advanced economies. They are extremely similar. If you look at the euro area, if you look at the UK, if you look at Japan, you'll see that all these real rates are effectively parallel to one another, more or less, and very low. Okay, so this is really a global phenomenon, this kind of low real rates. So this is the graph that most people look at, and a lot of people talk about. And they say, okay, how do we think about that? It looks like there's a decline in the natural rate, and then we are, monetary policy is trying to get to the natural rate to restore equilibrium. We had some unemployment. But what is driving this decline in the natural rate? Could it be demographics? So this is where we have all these debates about secular stagnation coming from demographics, or maybe could it be productivity growth that has been slowing down? So we have all these views coming from, in particular, Larry Summers on this, Bob Gordon. Could it be an increased demand for safe assets? Okay, so a kind of shortage of safe assets. So what is it? Could it be a saving glut? Could it be a deleveraging shock? Could it be that the type of technological progress is very different, and so the relative price of investment is shifting? So there are lots of views on this. And this is a big deal, obviously, for monetary policy, to try to understand. This is a big deal for even for business models of banks, of insurance companies. This is a big deal for pension funds. So it's a big question. And we are all a bit confused. And so when we are confused, it's usually a good thing to try to broaden up and to look at economic history or historical data in order to maybe figure out more what is happening in the recent data. So we also the last bit of the graph, okay, on US real rates, but there is a lot before the last bit. If you go back to the 19th century and you look at historical US real rates, you'll see that there was a lot of action over time in US real rate. So it's not the first time that we had low real rate. There has been some other periods, and there has been quite a lot of volatility there. So how do we interpret all these movements on the long run? So here, with Pierre-Olivier, we take a very simple approach, precisely because there are lots of possible explanations for what is going on. So we try to look at this data in a way that doesn't impose too much theory at all, to let the data speak as much as we can. And so we start with a framework which is purely a budget constraint of the world. Couldn't be much more aggregate, and there's not much in it, really. It's an accounting identity, to some extent, that tells you that the world wealth is really depending, at day t+1, is dependent on the world wealth at the period before, minus what you consume, and multiply by the return on this wealth. So that's an accounting identity for the world, which is a closed economy, right? So that's a very easy thing to start with. And so what is this wealth? Well, it's total private wealth. So there's financial wealth in it. There's also housing in it. There's non-incorporated businesses. There's land. There's also human wealth. And that is not an easy one. So this is all the component of wealth. And so the return is supposedly on all this stuff. Now, what do we do with this equation? We do something very simple, which is taken from Campbell, essentially. We just log linearize it around the steady state. And it turns out that in the long run, what you need is to log linearize around the steady state, is that the consumption wealth ratio is actually stationary, and it is in the long run. It's not on post-World War data, but it is on the long run. So we log linearize around this the steady state, and we get this very simple expression after iterating this budget constraint, which you have here. So it tells you that essentially your consumption wealth ratio today reflects the expected future discounted sum of all the return on wealth minus future consumption growth. So that's so that's very simple manipulation, and I haven't done anything fancy except a log linearization and iterating forward. So that means imposing some transversality condition. That's all I've done here. So what this means, therefore, this kind of accounting identity is that if you see a low consumption wealth to ratio today, that means either that in the future return on wealth will have to be low or consumption growth will have to be high. That's essentially what it tells you. Now, obviously, we're going to look at this relation in the data. So the big difficulty there is that we don't observe human wealth. So we do a few things in the paper that I won't spend too much time discussing here. But we break total wealth in private health and human wealth. Human wealth is unobserved, so we find a way of putting it in the error term. And in the end, whether this is a good approximation or not will be tested within the model by the fit of the model. We also do another thing, which is to decompose the return on wealth in 2 bits. The real rate of interest, so that's going to be the safe return, and then a risk premium. Okay? So we cut it in 2. And so now we have this new relation here, which is your consumption wealth ratio is the sum of 3 bits. One is an expected so the expected net present value of future risk-free rates. So these are the future real rates, risk-free real rates. Then you have the risk premium components, okay, the future risk premium. And then these are minus the future consumption growth. Okay, so these are the three components of that decomposition. Okay, so again, I'm not putting any theory at all so far. It's just an accounting identity with an approximation. Now, if we try to think about how in the data these things could look like, because we are going to construct all these objects in the data, and I will show you what we find. It's quite striking. We can start off putting then our kind of theories or view of the world in terms of what we would expect. For example, if in the data it turned out that productivity shocks were important drivers of the data. Okay, so if we think that in the world, really productivity is an important driver. Well, what would that mean? Well, in most models that we would drive down, productivity growth would have an impact on the future consumption growth terms, and it also would have an impact on the future real rates terms. So my 2 blue terms here in this. So I won't go into detail, but so in most models that we would write down, so productivity growth would show up in these 2 terms, and so in the data, if productivity growth is important, we should see some kind of negative co-movement between my real rate term and my consumption growth term. There's a negative sign here, so if these shocks are important, these 2 things should in the data co-move negatively. Okay, we don't know exactly then what would be the net effect of the consumption wealth ratio. It would depend on a lot of details of the model, so this is not too easy. Conversely, if we think that deleveraging shocks are important shocks in the data, these are shocks to the propensity to save, in most models you would predict a negative co-movement between the net present value of the risk-free rate and your consumption wealth ratios. So you can think about these issues a little bit there, like from your own kind of theory, if you like. But essentially, I'm not going to use this theory when I construct the data. So I'm just going to look at these components and then see what we find, and then try to suggest some interpretation. So for the data, we use data taken from Jordan and Taylor and also from Piketty et al. And we construct a world aggregate which consists on, of course, France, because the 2 co-authors are French. So that was the main motivation. But then we did add the United States, the UK, and Germany. And by these 4 countries, we do have a good chunk, especially going back to the beginning of the 20th century, of the big financial centers there. And so here's what we find. So what I'm showing you here is the global consumption to wealth ratio of this aggregate of countries. Starting in 1920, because we cut the First World War, because there the data for Germany in particular was really bad, so we didn't want to use it. So from 1920 till 2011, which was when the Piketty data was finishing, and you see that there are 2 periods essentially where the consumption wealth ratio normalized, here normalized, is kind of low, right? And those 2 periods are where we are now. That's us. And that's the period in the 1930s, okay, after the 1930s. So very interestingly, these 2 periods where we see the low consumption wealth ratios, they also coincide with the periods where people have talked about secular stagnation. So Hansen, who is the first person who talked about secular stagnation, talked about it in 1939. He's during that first period. And Larry Summers, who talked about it recently in 2013, that's the second period where there is a low consumption wealth ratio. Now, remember, our little decomposition tells us that the consumption wealth ratio should be equal to the sums of these 3 terms: future NPV of real rates, NPV of risk premia, and NPV of minus NPV of future consumption growth. Now, is the model making a lot, this simple model, kind of doing a lot of violence to the data? We have done a log linearization. We've put the human wealth in the error term somehow. Well, the answer, fortunately for us, is the fit is very good. In fact, the fit of this very simple VAR that we do is very good. So you can see that by seeing that this gray line that just appeared on the blue line, that's the model, that's the VAR, the predicted. And you see that it fits the consumption wealth ratio quite well. So this very simple model kind of is not rejected by the data. Now what is interesting, of course, is to look at these 3 components and to try to get an interpretation of what is going on in these 3 components. So let me add the risk-free, the net present value of the risk-free real rates here. And what is very interesting is that, as you can see, the risk-free real rate component tracks the consumption wealth ratio very well. Okay, so these 2 things are very, very closely related to one another. Okay, it's pretty striking. This is not at all the case for the risk premium component. You see that it doesn't explain much of what is going on in the consumption wealth ratio. Here it's not very much related. And the consumption growth component is also not doing much. So the stuff that is doing all the work here is the risk-free rate component. Okay, so that's very striking. Okay, so what does it mean? Well, it means that most of the movements in the consumption wealth ratio reflect expected movements in the future risk-free rate. It also means, by the way, the same thing, that if you look at the consumption wealth ratio today, it contains significant information on future real rates. Okay, that's saying the same thing. Now, this is not a causal decomposition. This is an accounting identity with an approximation. Okay, but let's still be very clear. And everything is therefore endogenous and interdependent. But you have to admit that the data says something very, very loudly, though, because what it shows you in terms of co-movements is very clear. So what is our interpretation? Well, first of all, so in the paper we go through all the possibilities. So we think of productivity shocks. We go through, what should co-move with what, etc. And essentially we come out saying, well, it doesn't look like there is a big role for this productivity shock. So it doesn't look like really that a Gordon story is going on. We also do the same thing, saying, okay, demographics. We have aggregate consumption. We split it into consumption per capita and population, and we say, okay, again, in most models, what would you expect? What should co-move, not co-move? And we come up as saying, well, it doesn't seem to be that much going on in terms of this. But the action is this joint dynamics of consumption wealth ratio and risk-free rate. And our preferred interpretation, and it's an interpretation, it's not a test by any means, is the following. So if you go back to what this consumption wealth ratio looks like, you will see that before it stays kind of low, you have two periods in which it goes down super quickly. This is this period. This is in the 1920s. It kind of really goes down quickly, okay, and then it stays down. And then this is this period, again, the 1990s. It kind of goes down, and we're kind of down. So what are the two characteristics of this period? These are the two periods in which we had this irrational exuberance in asset markets with extremely high valuations in all asset prices. So this was the roaring 20s in the 1920s, well documented, and also the exuberant period in 1990s, 2000s. So what's going on? If valuations of assets go up a lot, there are bubbles, your financial wealth goes up a lot. So the consumption to wealth goes down quickly. Okay, so this is what you see. You see this consumption to wealth going down quickly in these two periods. That's the exuberant times. And in both cases, it ended up badly. So the first one ended up in the 1929 Great Depression, and the second one ended up in 2008. So after this, in both cases, large financial crisis with massive disruptions to the financial sector. And what, again, is a possible interpretation is after these two massive crises, you have effectively deleveraging of the system. What's a deleveraging shock? This is an increase in the propensity to save. So this is a decrease in the real rate as a consequence of an increase in the propensity to save. Therefore, our interpretation of the data, that what we see in this long-run movement in consumption wealth ratio is the boom period before the big financial crisis associated with very sharp and quick decline in consumption wealth ratio because valuations are so big, financial crisis, and then deleveraging shock, which are linked to low consumption wealth ratios and to low real rates because of increase in the marginal propensity to save. So in other words, we think the preferred interpretation is to connect those low real rates with global financial cycles. And I say global financial cycles because in both cases, again, these financial cycles were really in all the big financial areas, they were all happening more or less at the same time. As a side product of this analysis, we can predict real rates 10 years ahead here. We are not going to predict the volatility very well, but we do predict the trend. So simply by observing the consumption wealth ratio today, we can look ahead and see what would be the 10-year real rate. So you see that we still forecast some kind of relatively low real rates, even though going up a bit. But our interpretation is really one of a cycle rather than a Gordon-style interpretation, which would be a trend, or if you believe in demographic explanations, also it's more like trend. So to conclude, because I think I'm more or less at the time where I should conclude. So what I try to share with you tonight are different points of views on the role of the US in the international monetary system and why the dollar matters in various ways on international financial markets and for the real economy. So I started with showing you the external balance sheets and what it meant for the exorbitant privilege and the exorbitant duty. So this is definitely connected, in my view, to the role of the US as a reserve currency and the US being a global insurer. Then we moved on to the issue of the global financial cycle, which is partly driven by the Fed monetary policy, which has effect across borders on financial variables. And this connects to the dilemma versus trilemma issue. So if you believe the US is monetary policy is an important determinant of global monetary and financial conditions, that means that other countries need something else than their standard monetary policy toolkit. They also need potentially this macro stuff or these capital controls. And then I started with something which looked unrelated, which is why are real rates so low, not only in the US, but elsewhere recently. But I ended up saying, well, in fact, this global financial cycle type story is maybe the most plausible interpretation given the long run movement in real rates that we see over the course since the beginning of the 20th century. So that's what I discussed. I would think there's a huge research agenda on a lot of these issues. There are more people working these days on the international monetary system from very different points of view. Some are doing work currently on invoicing quite a lot. There's Gita Gopinath at Harvard and Pierre Olivier who is doing some work on that. On joining invoicing and banking, that's Jeremy Stein and Gita again. Global banking, in particular Yoon Shin, and doing some stuff, Matteo Maggiori. There's the Exorbitant Privilege literature. There's the international transmission of monetary policies, which is a very active literature, especially also on the empirical side. Quite a few people around here contributing quite a lot. There's the reserve currencies literature with the insurance side, global financial cycles with the historical data of Schularik and Taylor. So there's a lot going on. And I of course, I miss a lot of things here. There's also, I think, a lot of stuff which should be done more on the theoretical side of the financial cycle, and in particular on explaining this kind of endogenous boom situations, credit boom situation that we've seen in the 1920s and in the 2000s. And there, so I've done some recent work which I presented today here, which tries to get at these kind of issues, but obviously it's just a first step. So let me stop here.
Thank you very much. Good. Thank you very much, Hélène, for this excellent presentation. And now I will take questions from the floor. Please.
Yeah, thank you very much for this very interesting presentation. If you allow, I would have two questions on the presentation and one on contemporary politics. But first, two questions on the presentation. You mentioned that the US would be like a global insurer. And I would be very interested, like, if you compare now the US financial crisis and the Euro crisis, if there is a difference based on where the crisis originated. Did the US take a bigger share where wealth went from the US abroad during the crisis that originated in the US, or did it not take anything? And the second question I would have would be, like, on the last point you mentioned on the cycles, you basically only take 4 countries, so like, and developed countries. So I mean, those are countries that probably around the 1930s had a large share of world GDP, but especially since the 1970s and 80s when developing countries emerged, I would assume that this share was way less, and maybe some of the decrease in consumption per wealth could be explained just by investments in other countries. So I would be interested in that. And finally, my question would be like on the role of China in the future. We have like a trade war maybe coming up. So I'd be very interested like in what sort of effects that has for the US as the big influencer. And maybe if you look at historics, there was a time when England was actually probably the one that influenced, like when Lombard Street was the one that influenced the world. So is there maybe already something that moves more to Beijing from New York? Thanks.
Oh, you can hear me, yes. And just remind me one second.
Okay, was there a difference between
the Euro crisis and the first financial crisis? So on that, I actually, if you remember, the graph I showed you on the decline in the net foreign asset position, you saw that in both cases, at the time of 2008 and the time of the Euro crisis, you saw a pretty sharp decline in the net foreign asset position. So indicating that in both cases, the US provided insurance, so wealth transfers, to the rest of the world. The decline was sharper and bigger in the 2008 case than it was in the Euro area crisis. But this is probably due, I mean, could be due to the size of the shock, right, rather than the... So the argument here that that we pursue with Pierre-Olivier is really that for any kind of global crisis, that is crisis which affect a number of big advanced economies at the same time, whether it originates in the United States or in elsewhere, is kind of irrelevant as long as the United States is providing the safe assets. So, in other words, as long as the crisis itself is not big enough to blow away the US, then you're going to have a similar effect on these insurance provisions, because the safe asset is going to be the dollar assets. And this is going to be what is going to be explaining this asymmetric wealth transfer in the external balance sheet. You could see it even though the 2008 crisis was originating in the US. You could see that actually the US treasuries were the only assets at the time of the crisis which were picking up values. So you could see flight into those assets, and you could see valuation increase for those assets. And this was despite the fact it was originating in the US. Okay, so that's the thing. On the second question, sorry, I should really write down because the second question, the global cycles
with the 4 countries only.
Thank you. And the 4, oh yes. So yes. So obviously, in the 19th century and the beginning of the 20th century, they were more or less really where most of the wealth was concentrated. I mean, more recently, sure, the world is a little bit more multipolar, but you would be surprised if you focus on financial market measures, and if you focus on where capital flows goes, etc. Still, the advanced economies, so I'm not saying only those ones, but the advanced economies are really disproportionately important in financial markets, much more than they are in trade, for example. So it's still the case that the financial stuff is very much concentrated among these countries. So what real rates do, I think, is still going to be massively driven by these guys, rather than maybe some emerging markets which are more important in trade. And the last one on so the effect of I remember that one on the trade war and etc. So I mean, I'm just going to give some, superficial generalities here, but clearly a country which is at the center of the international monetary system is a country which has all these kind of functions in terms of allowing the markets to work, providing with insurance, etc. A big example of that is what has happened in 2008 when there was literally a liquidity crisis at the world level, and liquidity was provided by the swap lines of the Fed. That was effectively underpinning the liquidity. That was the world lender as a last result in terms of liquidity. Now, to play that role, a country must be somehow integrated in the world economy and willing to play along within certain rules, certain institutions, respecting some rules. So if we go in a world in which the US is not in that category, I can only see that we are going to see the breakup of a lot of these things, and alternative arrangements, maybe more regional, becoming more important. I mean, I think that's really a key issue. So if you start to destroy institutions, trust, willingness to act as a reliable liquidity provider, I think there will be consequences for sure.
On your evidence on U.S. monetary policy and the global financial cycle, I mean, you showed that an exogenous increase in the federal funds rate leads to a reduction in global financial activity as captured by a number of indicators. Now, what we didn't see, I believe, what we didn't see is what is the response of other central banks, the endogenous response of other central banks. Yeah. It could be the case, I don't know, that other central banks are also large central banks systematically following the U.S., in which case maybe the reduction in, maybe the U.S. doesn't have, you know, necessarily a special role other than it's big, no? And the reduction in global financial activity is a consequence of this global tightening of monetary policy. And or not, it could be just that these other central banks don't respond.
Mm-hmm.
And the reason why I'm asking is, no, maybe we can draw some lessons from this exercise for the current environment in which, you know, the U.S. is raising interest rates. Other central banks are not following yet, and, you know, depending on whether your answer is one or another, the implications for the potential tightening of financial conditions worldwide may be different.
Yes, so that's a very interesting set of very interesting issues to discuss. So several points here. So first point is that I didn't show, but in the paper, if you look at the among the 25 set of impulse responses, you will see the endogenous response of the ECB and of the Bank of England to the Fed. And indeed, you will see that there is an endogenous response. So it's not immediate, it's delayed, but you also see but you do see that the policy rates moves up with a delay. Now, it doesn't mean that they are doing it to shadow the Fed or because of exchange rate consideration at all. I mean, it can be it's an endogenous response to all the other variables that are in the VAR, but there is an endogenous response. Now, the transmission to financial conditions that you see also in the impulse responses, if you look at what is going on in credit, what is going on in leverage, it is very quick. So it happens right after the tightening by the Fed, before this kind of endogenous thing that you see in the other rate. So this is why I think what we see is a response of some international financial variables to the Fed. And remember here, this is really a US monetary policy shock, instrumented. That is, so it's not a systematic component. It's a US shock which is unrelated to endogenous or to macroeconomic variables. So it's a response to these shocks that we see these quick movements in the financial so credit, leverage, and some asset price. This is pretty quick. The other stuff is more delayed. This doesn't mean that then after that there's not other endogenous dynamics. There is. So, you know, then the tightening of the other central banks also have an effect down the road on credit, etc. But the second thing I want to say is that I looked only at US monetary policy shocks. However, I do believe that if I could look in the same way if I had the instruments to look at the ECB monetary policy shocks, it's very plausible that I would also find some effect on the global financial cycle. So, I mean, I don't mean to say that there's only US monetary policy that has an effect on the global financial cycle. I find that it has, but I certainly would not dismiss the fact that the ECB could have. The Bank of England, I'm not sure. What I did, so I'm hoping at some point there will be the same type of instruments for the ECB than the ones I use for the US, and I think would be extremely interesting to run the VAR, but for the moment I don't have that. What I have done is look only at a bilateral thing, UK-US, and looking at, in smaller VARs, looking at whether, so the US had an effect on the UK, which it has, but the reverse was not true. But then the UK is certainly not the ECB, and that doesn't mean that the UK doesn't have an effect on the global financial cycle, which is something different from the US. So I think there is more to be done. I believe there are other people working on this type of issues now, trying to also to look at these kind of spillovers across different matrices of countries. So I think we are going to learn more. But you're right. So and that does go back to. Yeah. To the issue you raised.
Just a small comment, because especially in this time of, at this moment, with the ECB, with negative interest rates. So it's not
not
a special, yeah.
Yes. Yeah.
So it may work a little bit different when you have a big central bank with negative interest rates and another one tightening.
Right.
So probably the global financial conditions, there is a special role for the ECB given that they are in negative interest rates now.
It could be. So this would be the type of thing that we could estimate if we had this kind of corresponding instrument for the ECB, and that would be terribly interesting to look at it. Yeah.
Hello? Can you hear me? Yeah. Well, thank you, Hélène. I have just a comment and a question. The first one is, I think this evidence that you have on US monetary policy shocks having spillovers is quite interesting. But I was wondering whether, I sometimes think that this effect of monetary policy is a little bit exaggerated in the following sense. I'm sure many emerging market policymakers will look at your charts and they will use it to complain, as they've been doing, for instance, because they complain that US monetary policy has been too loose for too long, etc. Now, I can certainly see that you can have a monetary policy shock, have spillovers in the short term, but when you look at low rates for a long period of time, for instance, over the last 10 years or so, I mean, this is clearly not, I think, a monetary policy phenomenon, but rather the monetary authority endogenously trying to find the equilibrium interest rate, for instance. This is what Draghi says when the Germans complain about low rates. He says, well, rates are low, it's not my fault, the real rates, I'm just trying to set monetary policy accordingly. So I just wanted to know what you think about that. And the second point goes to your last comment, this decline in interest rates that some people attribute to secular forces like productivity slowdown, demographics that you mentioned. And you finish by saying, in your view, it's more of a global financial, more of a cyclical phenomenon. So if you don't think it's any of these candidates, what is your candidate to explain the ultimate driver of these cycles, in a sense? Thank you.
Okay, so very good. So indeed, I'm not doing that to shift blame on on the Fed or whatever. I do have the same view as Draghi, or I guess as most central bankers, which is there's some natural rate somewhere, and it happens to have gone down, and I will come back to why I think it has gone down in your second question. And therefore, the job of a central banker, in a way, is to try to act in order to restore full employment, or given inflation, the inflation target, to try to stimulate this. And therefore, you try to go down, you hit the zero-hour bond, and then there's all kinds of alternative things that. So I'm not shifting blames to the central banker in any way. I'm just documenting the spillovers that monetary policy has cross borders, which were not necessarily well discussed before, and I'm just trying to find the channels through which they happen, precisely in order to, from a theoretical point of view, down the road, to have better measures or better models of international monetary transmission, and to understand better these issues about financial stability and how financial stability in certain countries can depend on what important central banks elsewhere, what they might do. And I'm not saying what these central banks are doing, they should not be doing it. Just saying, given that's the way things work, then we do have to take seriously macro-pro, etc., and understand better these things. So that's really the philosophy on how I think about this work. Okay? So that's very clear. So yes, so cyclical view, and so rather than trend, and as you pointed out, a lot of the explanation of secular stagnation, secular means trend. And in this trend, so you have the productivity, you have the demography kind of people. But if you believe our interpretation of the data, so this is a financial cycle interpretation. So it's really coming after big financial crisis, and this is the kind of deleveraging period after the financial crisis. Now then, the deeper question is, why did we have these massive credit booms, financial crisis to start with, right? And this is where, in the end, on my research agenda, I have this slide saying, this is really, I think, this area of macrofinance in which we have to work more, is what is happening in these credit boom phases. And so we have different possibilities. And, you know, you here, you have some possibilities with bubbles. And today I presented these models where it's about risk shifting and moral hazard. And funding costs, essentially. So we have to understand better this kind of endogenous boom. But definitely once, if you model a boom as a kind of endogenous increase in systemic risk, at some point the system becomes very fragile because of, in my model, because of the leverage going up. And then at some point, even kind of relatively small shocks are going to get you a crisis. And it's going to be a crisis of financial intermediaries, so it's going to be a crisis which is going to have a lot of real consequences, which I think is what we had in 1929 and what we had in 2008. So this is in that sense that these two periods are very, very similar, I think.
Any other questions? Well, then I think we've made you work enough, and I would like to thank you very much for this nice lecture and also for answering our questions. And I'll let Sophia.
Yes. Well,
say,
just again, thank you very much, Dr. Rey, and thank you all for your attention. And now we can just meet next door for a small cover reception.
Thank you very much.